Stop what you're doing right now. Pull out your phone and check the silver price. Go ahead. I'll wait. What does it say? For most of you, it's showing something around $71 per ounce. That number is flashing across every trading app, every financial website, every price ticker in the world. And if you've been watching the charts lately, you're probably thinking silver is just consolidating, holding support, nothing dramatic happening. But here is the question nobody else is asking. When was the last time you checked what people are actually paying for silver? Because while your screen says $71, something completely different is happening on the ground. Right now, in Japan, verified retail transactions for physical silver, the kind you can actually hold in your hand, are taking place at 20,000 yen per ounce. At current exchange rates, that's roughly $130 per ounce. Let that number sink in for a second. $130 in the street market, $71 on your screen. That's a $59 spread. That's an 83% premium. And this is where we need to completely reset how we think about prices. In normal functioning markets, spreads are tiny. A 2% spread is just business as usual. That's dealer margin. A 5% spread tells you demand is heating up. Even 10% signals a supply squeeze. But 80%, that's not demand. That's not taxes. That's not shipping costs. That's not noise. That's a structural failure. Think about it like this. Imagine trying to book a flight online. The website shows tickets for $500, but every single time you click buy, it says sold out. Meanwhile, at the airport, the last remaining seat is being sold for $900 in cash. Which price is real? The listed one, or the one that actually gets you on the plane? That's the difference between the paper price and the street price. The spot price is the price of a financial contract. The street price is the price of availability of reality. And right now, those two worlds have completely split. There are now two silver markets operating at the same time. And whether you realize it or not, you are already living in one of them. So here's the obvious contradiction. If silver is trading at $71 in New York and $130 in Tokyo, why hasn't Wall Street stepped in and fixed this already? This is where the entire financial system is supposed to shine. Because in theory, this kind of price gap shouldn't exist for more than a few hours, maybe a day at most. The moment a spread like this appears, arbitrage is supposed to erase it, and arbitrage isn't complicated. At its core, it's the simplest trade in finance. Buy low in one place, sell high in another, pocket the difference. Let's walk through the math. A bank buys silver on the Comex at $71. That same silver is selling in Tokyo for $130. Even after paying taxes, minting, insurance, and shipping. There should still be $30 to $40 per ounce left in pure profit. Scale that up just slightly on 1 million ounces. That's roughly $30 million. That's not a risky bet. That's not speculation. That's supposed to be free money. Banks like JP Morgan and Goldman Sachs exist to exploit exactly this kind of inefficiency. They don't ignore $30 million opportunities. They chase them aggressively. So the real question becomes uncomfortable. Why aren't they doing it? The answer is simple and disturbing. They can't. The bridge that connects the paper silver market to the physical silver market is broken. On paper, silver looks abundant. Contracts trade with a click. Liquidity appears infinite. But converting that paper claim into actual metal is where everything breaks down. Refining capacity is limited. Secure transport is constrained. And most importantly, the silver sitting in New York vaults is far less liquid than advertised. If a bank tried to withdraw 10 million ounces from the Comex today to ship overseas, it wouldn't trigger a delivery. It would trigger a stop. The exchange would force a cash settlement instead. And that's the key detail most people miss. Cash settlement replaces metal. This is what we mean by bifurcation. There are now two realities operating at the same time. In reality, A, the paper world silver is cheap, plentiful, and trades at $71. In reality, B, the physical world, silver is scarce, delayed, and trading at $130. Once trust breaks between those two worlds, arbitrage doesn't heal the market, it dies. And when arbitrage dies, prices no longer converge smoothly. They separate permanently. Now here's where it gets even more interesting. There is a phrase circulating all over social media right now. A $6 billion loss would destroy any bank. That statement feels true because for almost everyone watching this, a $6 billion loss would be catastrophic. Total annihilation. But here's the uncomfortable reality. A $6 billion loss only sounds fatal if you don't understand who you're dealing with. Let's replace emotion with math. According to the CFTC Commitments of Traders report, commercial banks are currently holding a net short position of roughly 40,000 silver contracts. Each contract represents 5,000 ounces. So do the arithmetic. 40,000 contracts times 5,000 ounces equals 200 million ounces of silver. That's the size of the exposure. Now imagine silver moves from $71 to $100. That's a $30 move. Multiply that $30 by 200 million ounces and you get a $6 billion mark-to-market loss. This is the number that fuels the headlines. This is the number behind the banks are finished narrative. But here's the part almost nobody talks about. Scale.JP Morgan alone has a Tier 1 capital buffer of roughly $300 billion. The big four U.S. banks collectively sit on more than $10 trillion in assets. So put the numbers side by side. On one side, a $6 billion silver loss. On the other, a $300 billion capital buffer. That silver loss represents roughly 2% of that buffer. Does it hurt? Absolutely. Does it damage quarterly earnings? Yes. Does it trigger bonus cuts, trader firings, and internal stress? Without question. But does it bankrupt the institution? No. This is where the online narrative breaks down completely. In the real world, banks don't operate like retail traders. They don't make single one-sided bets and pray. They hedge constantly. While those banks appear short 200 million ounces on the visible Comex market, they're very likely long large quantities of silver exposure in the OTC market through minor forward contracts, private deals, and off-exchange agreements. This is not a solvency crisis. This is a liquidity crisis. A solvency crisis means you're broke. A liquidity crisis means you're rich, but you need cash right now. And banks that are solvent can fight. Banks that can fight will not go quietly. They are wounded, yes, but a wounded institution with trillions in assets is far more dangerous than a desperate one. And that brings us to what just changed everything. If you want to understand why this silver story is different from every squeeze that came before it, you need to mark a date on your calendar, January 1st, 2026. That wasn't just the start of a new year. It was the moment the silver market crossed a point of no return. Because while everyone was distracted by price charts and bank losses, the real catalyst wasn't on Wall Street at all. It was in Beijing. Overnight, China's new export regulations for strategic dual-use metals became active law. And the language used, export licensing, has misled a lot of people. Licensing sounds harmless, administrative, temporary. In reality, licensing is how governments quietly impose soft bans without ever using the word ban. Under the new rules, only state-owned mega refiners are permitted to export silver out of China. Hundreds of private refiners, recyclers, and trading firms that previously fed metal into global markets are now cut off completely. And even the refiners that technically can export are no longer incentivized to do so. Why? Because China's priority has changed. Look at the numbers. China produces roughly 3,500 metric tons of silver per year from its own mines. Its internal consumption exceeds 6,000 tons annually. That's a 2,500 ton deficit, and that deficit is growing. China dominates global solar manufacturing, and newer technologies require 50 to 80% more silver per watt than older designs. Add electric vehicles, electronics, and defense applications, and there is no surplus left to export. From Beijing's perspective, exporting silver right now isn't trade, it's leakage. Every ounce sent overseas is an ounce not available for domestic industry. So the wall is real, and once China closes that gate, the consequences cascade outward. The United States and Europe are structural deficit regions. They do not mine enough silver to meet their own demand. For decades, they relied on imports from Mexico, Peru, and China to balance the system. Remove China from that equation, and the entire Western market tilts. Now, Mexico and Peru become contested supply lines. Western buyers must bid higher to attract metal, and this is where psychology takes over. When companies sense scarcity, they stop ordering just in time and start ordering just in case. This is called inventory hoarding. A factory that normally orders 10,000 ounces suddenly orders 20,000 not because it needs them immediately, but because having none is fatal. That behavior amplifies shortages. It forces premiums higher, and it creates a feedback loop that no paper market can override. Once China locks supply, silver stops being priced purely by finance. It becomes a geopolitical asset. So let's kill a dangerous fantasy right now. Silver's not going to wake up tomorrow at $100 and solve everyone's financial problems in a single candle. That idea might get clicks, but it gets people wiped out. What's coming next is not a moonshot, it's a grind. And understanding that difference is the key to surviving and winning what comes next. The direction is clear. The supply math, the China shock, the inventory drain, all of it points higher. The price must rise. But the speed of that rise is still controlled by institutions that have capital algorithms and rule-making power. And they will use that power. Expect days where silver surges several dollars in the morning, only to be smashed lower by the afternoon. These moves are not random. They are designed to trigger fear, margin calls, and stop losses. Now let's talk about the real clock inventory. According to the latest data, registered silver sits at 38,200,000 ounces. That's the metal actually available for delivery. Global silver consumption runs at roughly 1.1 billion ounces per year, or about 3 million ounces per day. Do the math. That's roughly 12 days of global supply. If registered inventory continues to fall, the exchange has one final escape hatch forcing physical delivery contracts can be settled in cash. So here's your strategy. First, do not chase panic pricing. Japan's 80% premium reflects currency fear, not smart entry. Second, exploit suppression, don't fight it. As long as banks are holding the paper price down, they are subsidizing accumulation elsewhere. Third, and this cannot be overstated, physical only, paper contracts can be settled, rules can change, claims can be physical ownership removes counterparty risk entirely. Finally, watch the real signal, 30 million ounces registered. That's the threshold where the endgame accelerates. Below that level, the system stops pretending everything is normal. This isn't about getting rich overnight. It's about opting out of a system that is quietly breaking. So ask yourself the only question that matters. When the noise fades, the rules change, and the screen price stops meaning anything. What would you rather be holding? That choice is the strategy, and the window to make it doesn't stay open forever.